The fiscal picture of the U.S. is lousy. I will just say it bluntly and plainly. Administration after administration after administration, and Congress after Congress after Congress, on both sides of the aisle have just kicked the can down the road for other people to fix it. Well, at some point, it becomes really, really painful to fix. There are things we can do today, smart, intelligent, rational things that can reduce the amount of the growth of our federal deficit. But unfortunately, it's not politically wise or expedient to do those things.
Christopher Zook, founder, chairman, and chief investment officer of CAZ Investments. It is so great to welcome you back on the show. Thank you so much for joining me again, Christopher.
Oh, it's my pleasure. I always enjoy it.
Well, I do too. And I got to say, your last episode 72, was one of my most downloaded episodes. So I know the audience definitely appreciated having your perspective. And I'm excited to have you here. We're talking on Fed Day. And I would just like to start with the big picture, the macro view for you. Let's set the table there. What does that look like for you today?
You know, it's interesting because in order to say that, well, let's go back in time a little bit. February, March, April, the markets were convinced that we were going to see the Fed start cutting by the end of the year. And here we are in September, and people are wondering if they're going to raise one or two more times before the end of the year. So the markets were very optimistic. They were very hopeful, and hope is not a good investment strategy. So right now, everybody's trying to realign with what the Fed is going to do. What we expect is, and what we've said for now almost a year, is that higher for longer is the most likely outcome. Even if the Fed does pause today, which we expect, even if the Fed does pause a couple more times, we don't expect them to start cutting anytime soon. And the reason is that the Federal Reserve is in a box they have not been in for 40 years. If they start cutting too quickly and inflation starts to take back off again, then the Federal Reserve will lose credibility. On the other hand, if the Fed keeps rates too high, too long, and we sink into a deep, deep recession, the Fed loses credibility. So they're really stuck. But what their mandate is, they have told us over and over, is a 2% target. Well, in order to get there and stay there, most likely rates are going to have to stay higher than people want them to for longer.
Yeah. So I take it you expect higher for longer. And it's kind of like if they're in a box and they're in a tough spot. Do you think they're going to lose credibility? What's kind of your thought there?
No, I don't think so. As long as they continue to do what they say they're going to do, I don't think they lose credibility. And I think that they've done a very good job of advertising to the markets of exactly what people should be expecting. Earlier this year, everybody didn't believe them very much, and so they were hoping the rates were going to come down quickly. Well, now they realize actually they meant what they said, and the dot plot does matter. And what they are forecasting is therefore rates not likely to be cut until mid next year or even late next year. So with that said, what we expect is that the Fed is going to maintain credibility by being consistent in their messaging. We think the message that they give us today is that we are pausing just to get more data. And then as the data adjust, we will adjust. But until such time as we see sustainable low inflation, and that is hard with oil prices where they are. My guess is we'll probably talk about that at some point. But with right now energy prices where they are, it's going to be very difficult for the Fed to all of a sudden start lowering rates. So I think the Fed's got good credibility right now, and I think they're going to keep it.
Yeah, I want to hear more on the inflation part. And you mentioned the energy prices. Let's talk about your views there on the inflation front.
So we started talking about a year and a half ago about the word that nobody wants to talk about, which is stagflation. That's where you have a stagnant economy and a high rate of inflation. And history shows us that that is the worst performing environment for basically every risk asset. There's a few exceptions, but not many. Stocks, bonds, real estate, etc., tend to be very negatively impacted by stagflation. And that is definitely what we feel like is happening here today, where you have a relatively stagnant economy, and some would argue a rolling recession through various sectors right now, but with stubbornly high inflation, compounded by higher energy prices, all of which is a tax on the consumer. And you have a consumer that right now is under a barrage from multiple fronts. And so when that starts to play through, you start to see not great growth in the economy, but high costs from inflation. And that makes it very difficult for the Federal Reserve to cut interest rates. And at the same time, it's hard to get earnings growth in that environment because profit margins get squeezed. That usually affects valuations. All that leads to just a really tough environment to make money by investing in plain vanilla assets.
Yeah, that's an interesting point. You were pointing out it's the worst performing environment for every risk asset. It's terrible for stocks. It's terrible for bonds. Okay, let's extrapolate that out because kind of like, I guess like the traditional is the 60-40 portfolio. Like what could this mean for folks if they are invested, I guess, in a more traditional way, if you will?
It's really tough. And, I serve on and chair the investment committee for the state of Texas Pension Review Board. So we get a front row seat to see how plans all across the state of Texas are trying to tackle this issue. So first I'll talk about the positive of where we are today for somebody that's trying to run a more traditional portfolio, 60-40 or some similar mix, and that has an actuarial assumption that they're trying to reach, which is true for individuals. They just don't really call it that, but certainly for institutions. The first positive, of course, is that interest rates are higher. So if you can get 5 and change on a T-bill, well, that's a lot easier to make a 6.5% or 7% actuarial assumption. If corporate bond rates continue to go up from where they are today, you can actually potentially immunize your portfolio by locking in long-term interest rates that are equal to your actuarial assumption. Well, if we get that, for those folks, it's a real positive. For most of the other investors in the universe, it's not, because it means rates went up a lot from where we are today. But those are the positives that come from the high rate environment that we have today. And it certainly helps those on a fixed income, those that are trying to generate income to live off of. It does help them there, but they're fighting against the inflationary pressures that come from the other side of the cost, push inflation that we obviously are dealing with. They have to make more income to maintain the same lifestyle, and the interest rates are a direct reflection of those higher cost increases, and they kind of offset each other. The negatives are also pretty obvious, which is if rates are going higher, well, then obviously cap rates or valuations or PE multiples or risk premiums, all these other things that you would refer to are obviously under pressure. And when that occurs, it makes it very difficult for stocks to make headway. So extrapolated forward, to use your term, you have a 10-year horizon and you expect to make maybe 7 or 8 on your stocks, maybe, and I would argue that it's probably not likely to occur, but it could, 7 or 8 on your stocks, and your bonds are going to make 4 to 6, well, that's not bad for someone who's looking to make a 6 to 7% return. The challenge is, where does the volatility happen? And in this kind of environment, in this kind of stagflation picture, you typically have some very serious drawdowns that investors are going to have to ride through and stomach. And that makes it very difficult for them to stay the course. But I could also make you a case, Julia, and nobody's going to want to hear me say this, but I can make you a case that we're entering into a lost decade similar to what we had from 2000 to 2020, 2011 to 2020, where you end up with basically the S&P at the same level. And I could give all kinds of reasons for that, but where valuations are today, where the risk premium is today, or the lack thereof of risk premium for stocks over bonds, it's just really hard to see how stocks are going to make a lot of headway unless you happen to own the right few companies that are going to benefit from some major tailwinds that are out there.
I do want to hear more on this thesis around a lost decade. And can you elaborate a bit more there? And who might that impact the most? That I imagine that decade could be critical for, maybe certain demographics. Maybe it's millennials or younger generations, older generations, or maybe that's not a good question, but I am curious.
No, it's actually the right question to ask, because of the fact that the lost decade of 11 to 20 impacted older people the most, and that would be the same here as well. If somebody is planning on growing their portfolio by 50% more and then retiring, and they find out that it actually didn't grow at all or it grew very modestly, then they may not be able to retire, and they may be forced to live or to work longer. And of course, as we all hopefully continue to live longer, then you start running into a funding gap that is going to be very difficult for the average investor, particularly in their 60s, to be able to tolerate. So the lost decade came from last time, and I think it could come this time, from basically a very tepid earnings growth over that 10-year period of time. And compound that with a very expensive valuation, going back to the term, very little risk premium over bonds, that could cause ultimately stock valuations to decline, not off a cliff, but gradually. And to be overly simplistic, it will never work out exactly like this. But if you had 5% earnings growth for the next 10 years, and you had a reduction in valuations by approximately the same amount, well, then you end up right where you started at the end of 10 years. People got used to various periods like 2009 to 2018, where you had this massive expansion of valuations and a significant increase in earnings. Well, those two combined cause great returns to occur in stock prices, and nobody wants to admit that that can also go the other way too. And one only has to look back to the 70s and the 80s, the last time we had an economic environment like we're dealing with today, and the Federal Reserve in a box like we have today, to be able to see how that actually can happen. And the last point that I'll make is that the people that'll be most impacted by that are the passive investors who just hope that the S&P 500 or the Russell 2000 or the EFA index, they don't have to do anything. It's, literally just set it and forget it. Well, that's really tough if you have the indices themselves really go flat for the next decade.
So in that, the passive is, do you think then, I guess in that scenario, you'd see more of a return to like a stock pickers market, more active investing?
That's where
I wonder if that's a bit of a lost art, if you will, like the Peter Lynch style.
Yeah, it's interesting because I made the comment on another appearance that, the vast majority of people that lived through the 70s and the 80s and were actually stock pickers in that environment, they're all retired. Not all of them, but the vast majority of them are retired. So most people have never lived through this environment. Most people do not know the playbook, and most people have never studied it as much as they probably should. So that would be my message to all the investment professionals, which is go back and study the 60s and the 70s and the 80s, because living a 1980s, 90s, 2000s playbook today is a recipe for pain. So go back and be a student of history so that we're not doomed to repeat it, to quote Churchill. So when you think about the passive to active argument, I think there will not be this massive shift away from everybody's index funds. I think what will happen is it will be gradual, and I think you're going to have people have to find another solution. And bonds may be that, because people will see interest rates get high enough, they go, that's kind of a no-brainer. Let me just lock that in for the next 30 years. We're at 440-ish on the 30-year Treasury today. You get a 7 or 8% 30-year Treasury, people will have learned from the 80s and they'll go, yeah, I'm good with that. Well, obviously that's really bad for stocks if that happens.
Yeah. On the indexing front as well, this conversation's come up several times on the show this year, and I find it to be a fascinating conversation. Like all of the money that's gone into indexing, ETFs and whatnot. Do you have a view there that are we creating a bubble when it comes to that? Like what I get, like when people buy and push all these valuations up, but what happens when people start to sell and they have to sell the underlying assets in these indexes?
So I'll answer the question two different ways. And the answer is that what most people don't realize is how much bigger the private markets are than the public markets, because they see the trillion-dollar names like Apple and others that, they're massive. But if you actually look at something like the Russell 2000, where over 50% of the index participants are losing money, it's a very, very different animal. And so the private markets are so much bigger, and they're becoming even more relative weight compared to the public markets, because being a public company is a pain in the neck. From a regulatory standpoint, from a compliance standpoint, from a managing of investor relations, it's tough. And so a lot of companies are choosing not to go public unless it really is strategically valuable for them. But so when you extrapolate that, and you do look at so much money going into the index funds specifically, well, the thing when someone is managing an index fund, they're always a buyer or a seller and never both. So rarely both. It's some exceptions to that. Never say never, never say always. But when you start talking about the life of a manager of an index fund, whether it be in fixed income, preferred stocks, or equities, et cetera, you come in the morning and you find out this is how much I have to buy today. And then you turn around and the next day you come in, this is how much I have to sell today. And of course, almost every index fund is doing that at the exact same time. So you have the almost entire market becoming a buyer or a seller at the exact same time. The last couple of months have been interesting because it's been more balanced of inflows to outflows. And so you have not seen anything extreme. But if you go back to October of last year, go back to January of last year, when everyone was basically pulling money out of the markets in general, the index funds were completely forced to be sellers almost all at the exact same time, which means there's just a supply-demand imbalance, and that can accelerate both increases, but more worrisome, decreases. Fear is a much more powerful motivator than greed. Greed, people will push things up, but when everybody says, I want out and I want out now, it can get really ugly really fast.
Yeah, that's a good line. Fear is a much more powerful motivator than greed. Wow. I was reading your letter. I think, it was the most recent investor letter that came out. And I have a couple of questions on that as well. And just, thinking about the markets, you were writing about a dichotomy in the markets. Could you elaborate on that?
So we've had the Magnificent Seven that have driven, the technology stocks, NVIDIA, Amazon, Google, Alphabet, et cetera, that Microsoft, that have really benefited from this AI craze, artificial intelligence craze. And to be very clear, it's not a craze from the standpoint it's not real. It is absolutely real, and it will change everybody's business, your business, my business, and everybody else's business. We're going all in on AI as a firm. But so the stock craze, however, has been that those who are involved in AI have dramatically performed well, and the rest of the market was kind of carried along a little bit with it, but the vast majority of stocks really didn't benefit from that. The vast majority of stocks are still being valued based on their expected earnings and their expected cash flow going forward. And when you look at a very tepid, stagflationary environment, they're not getting a lot of love from the market. So the Magnificent Seven are getting all these big inflows, but there's such a large percentage of the S&P. The Magnificent Seven are over 45%, 50%, depending on the day, of the NASDAQ 100. And so you think about 30% of the S&P, that's really what's happening. And underneath the surface, it's a very, very different story. And so most investors are only focused on those large mega cap that are doing well. And unfortunately, that can bite them. As an example, from the peak in 21 through the trough in 22, those same seven stocks, they declined by an average of 47%. Well, if they make up 30% of the S&P 500 and they go down 47%, which again, at some point they will, can't say now or 2 years from now or 2 months from now, but when they decline because they are more volatile, it's going to create enormous downdraft in the S&P 500 and in the NASDAQ, and people potentially could be very, very much caught flat-footed.
Yeah. And so before I move on to opportunities, and I do want to get into that, just more like the economic picture, because I imagine, okay, so there's a disconnect right now between the market and the economy. And like, as you were talking about earlier, the consumers got a bunch of issues and whatnot. I want to zoom out a little bit and talk maybe a bit more about like the fiscal picture here in the US. And is that a concern as well? Because we did have the downgrade in August. How much do you think about like the fiscal picture of the U.S.?
The fiscal picture of the U.S. is lousy. I will just say it bluntly and plainly. Unfortunately, administration after administration after administration and Congress after Congress after Congress on both sides of the aisle have just kicked the can down the road for other people to fix it. Well, at some point, it becomes really, really painful to fix. There are things we can do today, smart, intelligent, rational things that can reduce the amount of the growth of our federal deficit and obviously our debt level. But unfortunately, it's not politically wise or expedient to do those things. So therefore, nobody wants to do it and not get reelected again. So those, unfortunately, factors are going to continue to be a pain for us. And it's going to take people of immense courage to go against what might be popular to be able to do things that actually make common sense for the American people. And, when I think about my children and my son and my grandson, they obviously are going to be the ones stuck holding the bag on all of these very, very bad policies that we have today. But when you think about the other implication, more short term, is just supply and demand. One of the reasons why rates have continued to back up here, even though the economy is clearly slowing, is that you have a supply-demand imbalance. There's just too many bonds that need to be sold by the federal government compared to the amount of buyers. And of course, like any other market, if the buyers know that there's a lot more supply coming, they tend to be patient. They tend to wait, which causes prices to drop. In this case, to cause interest rates to rise. So the consumer is what everybody is hoping is going to bail out this fiscal just quagmire that we're in right now. And unfortunately, the consumer is right now being attacked from so many different directions. Credit card rates surpassed, on average, 22%. You obviously have a whole bunch of people that got a pass on their student loans that they shouldn't have, in my opinion, but they got a pass on their student loans for a long period of time, and now they've got to pay them back. Well, that money's got to come from somewhere. So they're wanting to maintain their lifestyle, but their mortgage rates are obviously gone up to where a lot of people just can't move because they've locked in a good rate and they don't have the ability to relocate. If they lose their jobs for some reason, it's devastating for their fiscal picture. And then you have just rates higher in general for everything else. And of course, the fiscal money that everybody got and spent, in most cases, now that's gone, and they're living off of credit cards in order to maintain that lifestyle they got used to. And at 22%, it's pretty much impossible to pay those suckers off.
Yeah. Definitely like the cracks in the consumer. And I want to point this out too for folks because you successfully betted against subprime, which at the time, that was a very contrarian call, if you will. And so if you think about like our environment now, I don't know, how do you kind of handicap it to like your feelings, pre-financial crisis, like the worries there? I don't know. Maybe that's a bad question, but I am curious. Yeah.
No. It's when we shorted subprime, it was very much a contrarian trade. Obviously, it was something that the vast majority of people made the statements that houses can never go down in value. And of course, anybody who studied history knows that's just not true. They don't do it typically very much, but when you get a bubble as big as we had in housing, when that bubble bursts, it's going to be very painful. So that was a contrarian trade. Today is different. The good news about today is that people's balance sheets on average are much better than they were then. They're not as over-levered. So I'm not expecting massive amounts of default on home mortgages and things of that nature unless we saw a dramatic spike in unemployment. Obviously, if people lose their job, it doesn't matter how good their balance sheet is. Eventually, if they don't get another job, then they're not going to be able to stay in their home. They're either going to have to sell it at a bad price or they're going to have to give it back to the bank, if you will. Now, the good news is that the actual loan to value ratio, because inflation has been hot enough and home prices have gone up enough that they're in pretty good shape. So that's not actually what I'm concerned about as much right now. But what I am concerned about is the ability for them to maintain their spending habits. And because they're the largest component of GDP, if they have to pull back their spending, which they've already started to do, then it's going to have a very significant stagnation effect on the economy while we have continued inflationary pressures from supply chain to re-onshoring things to just the reality of costs going up, particularly as you have, in many cases, artificial wage inflation because of mandates and government rules. All that leads to inflationary pressures and obviously energy at the same time that they are not in great shape as far as being able to spend more money. So we're seeing that as an example right now, probably more than anywhere else in autos. Auto defaults right now, and of course, everybody bought a new car between 2020 and 2022. I mean, it was like the rare person that did not. But so unfortunately, they also got much too high of a borrowing on their car for much too long. And now those rates are in many cases just unsustainable, or those payments are unsustainable for those borrowers. And they're handing the keys back at a rate that's as high as we've seen since the global financial crisis. The economy is a heck of a lot better today than it was then, but you have just as many people as a percentage handing the keys back as we did then. That's a lot of pressure on the consumer.
Yeah, certainly. And with CAZ Investments, I know you all take a thematic approach. And with the stagflation being the thesis, and I know you look for dislocations, what for you is the trade that is, I guess, like the most interesting in this environment? What is that trade for you?
So we're taking what we refer to as a barbell approach, to where we want to find things that are very, very, very predictable, that we believe are going to persist and do well throughout the economic cycle, regardless of whether or not we have inflation, stagflation, or recession. It's hard to find, but in the private markets, there's quite a few businesses that fit that criteria. The growth of private assets as an asset class is definitive. And when you own a firm that manages private equity or private credit or infrastructure, et cetera, there's a very predictable business model. When you own professional sports teams, as an example, it's a very predictable revenue model. As an example, here in Houston, for the home of the Astros, it's Minute Maid Park. Minute Maid doesn't get the choice to whether or not they're going to pay for that right to have their name on the stadium every year. They just have to pay the bill regardless. So you will have a lot of long-lived revenues through assets like that. And then on the other side, we see very significant opportunities that we can take advantage of that are going to have more risk, but they're also going to have a lot more potential upside opportunity and be more timely. Examples of that would certainly be energy. There's just a supply-demand mismatch, and there's a whole lot of reasons we can talk about for that. But as long as that is still there, and as long as people want to be able to charge their iPhone and fuel their cars or charge their cars, there's going to be an enormous amount of demand for energy that is not going to be able to be met here in the United States. And that means that people overseas are going to be able to set prices. They're really incentivized to set prices very high. And so naturally, that is a trade that we think has lots of opportunity, both in traditional energy, but also in the evolution of energy as well. Then you do have dislocations. The one that we are most excited about, it's not here yet. It's not going to surprise anybody. It's something that we know is coming, though, and it's like watching a very slow motion train wreck, and that is commercial real estate. Not necessarily residential real estate. There may be some pockets of opportunity there, but the real dislocations are going to be in commercial real estate, obviously office being at the top of that list. But we think there's going to be also significant distress in apartments, multifamily, and other things that have been all based off of a low interest rate environment where they have overbuilt, and a lot of that supply is coming into the market that could create softness. And you could have good assets that just have a bad balance sheet. Between 2024 to 2026, we had the largest wall of commercial real estate loans coming due that we've ever seen in the history of mankind, basically, since we started keeping records. And the reason for that is between 2018 and 2021, everyone refinanced. We built a lot of stuff, but everybody refinanced at very low interest rates. And most of those commercial mortgages were 5-year or 7-year fixed rates. Well, as those rates reset in 24 to 26, or they mature, even worse, it's a good asset maybe, but it's a lousy balance sheet and it's going to have to get restructured. We are going to be a major player in the restructuring of those assets.
Meaning like you'll be looking for, I guess, opportunities to like actually buy some of these assets. I think they'll be distressed at that point. Is that what you're thinking?
For sure. We will utilize the playbook that we used post the global financial crisis. After we shorted subprime, we also made a tremendous amount of money, in many cases more money, by picking up the pieces after the global financial crisis. Distressed real estate, distressed financials, distressed credit. All of those are going to be impacted by what we just discussed, particularly commercial real estate, because the largest owner of that commercial real estate paper is regional banks. They've already had a tough time. It's only going to get worse. You also have, of course, the real estate itself, which you could buy a building for potentially 30 or 40 or 50% of replacement cost. You may not still want it at that price, but if the price is good enough and you have a feasible way to be able to keep it occupied at enough of a level to generate cash flow, that's attractive. Buying the debt of those, the loans themselves from distressed sellers who just have to sell, then obviously going in and restructuring that paper, restructuring that asset, improving the loan to value can still be a very profitable solution for investors that know what they're doing. And we are gearing up to be able to take advantage of that and specifically partner with people that have expertise in each of those areas to be able to be the boots on the ground, if you will, to take advantage of what we think is going to be a generational opportunity.
Wow, generational opportunity. And as you mentioned, it's a slow motion train wreck to get there. I guess okay, I don't know if you could share this, but are there markets that you're keeping an eye on for the commercial real estate? Maybe you don't want to give that away.
No,
and then how do you do the occupancy after? Is that whole work from home, remote work? Do you see that as a lasting trend, or you think that's kind of overblown and people are actually going back to these spaces?
I think it's a little bit of both. I think that we will have a permanent change and that there will be a lot more work from home than we had pre-COVID. But I also do think that a lot of companies, and we're already seeing that, are going to start mandating for people to come back to work. And there's several financial services companies that have said, you want to work from home? That's fine. Don't work.
Yeah.
But if you want to work, you're going to be here. We're now seeing technology companies doing the same thing. Because what people are finally starting to realize is that work from home has a lot of benefits. And for some things, for some roles, some jobs, it's actually in many ways better. But there's two things that really are almost impossible to do remotely. One is to hire people, and the other is to develop people. It's really hard for somebody to be trained explicitly and completely remotely without the osmosis that comes from being around each other. So back to your question, we do think that there will be a little bit of both, more work from home, but we'll also get back to some occupancy. In certain cities that are falling apart, it's going to be much harder. Whether you talk about bad policies or getting overrun with, bad influences, if you will, around the offices in certain cities, people just won't go there because they don't feel safe. Well, if they don't feel safe, then it doesn't matter what assets you buy or what price that you pay for that asset, it's going to be tough to make money. Almost in every situation, you have to be able to see over a 3 to 5 year period that things are going to get back to a more normalized way. But there's also a lot of other trends that are coming out there. Certain large cities have already said, hey, we're going to give people tax credits to convert many of these offices to multifamily. It's very expensive, but it's doable. And in many cases, it's feasible if you can buy the asset cheap enough to be able to then go in and improve that, renovate that, use the tax credits, be able to then sell townhomes or condos or rent them, etc. But that is an interesting way to convert. But it goes back to something I talked about earlier. If you have a whole bunch of new supply coming online with tax credits, what does that do to traditional multifamily? That's more supply coming to the market that puts more pressure on those traditional multifamily that have bad balance sheets, which means more likely you're going to see more distress. So it's an interesting situation, but to your question specifically, the super large markets, of course, you want to look at those, but there's a lot more of the regional markets that we think are going to be better opportunities where you truly have good assets. I mean, there's an opportunity we're looking at right now. It's 75% occupied. It's not great. It's not terrible. I mean, there's some buildings in San Francisco at 12, right? So, 70 is not good, but it's not bad. And if you have the right balance sheet, you can make good money on 70% occupancy. And if you can grow it to 80, now you're really doing well. And if it goes to 60, it's not great, but it's not going to hurt you that bad. So there are pockets of opportunity, particularly in the faster growing markets. Now, clearly in places like Houston, Austin, Miami, Nashville, there's so much population growth. It's a different animal entirely. But if you look at other places around the country where it's more stagnant to small growth, there is definitively the opportunity to be able to make significant money from buying assets in those markets. And that's a lot of the places we're looking.
Yeah, it's so interesting. Okay, so I get commercial real estate, the focus on real estate right now, but also you mentioned energy and maybe some of the asymmetries and dislocations there. Can you walk us through the thought process on energy?
So energy is obviously a hot topic and people are very passionate about it. So one of the things that we try to do is to remove emotion from investment decisions. We remove them because they just tend to lead to bad decisions. Well, in our situation, it doesn't matter the fact that we're in Houston, which is the energy capital of North America, and some would say the world, but it's the fact that we know the realities of energy. Throughout history, you've never had a transition of energy. It's actually never occurred. You've just had new sources of energy. That's why we refer to it as the energy revolution. We will absolutely have more solar going forward, more hydro going forward, more all of the above, wind, etc. We think nuclear is going to be a massive opportunity to truly disrupt the status quo, but it's going to require a lot of courage by politicians primarily to recognize that, you don't judge a car by the quality of the car in 1972. You also don't want to evaluate a nuclear reactor today based on what happened in 1972. So you have to look at it with a fresh set of eyes, a new perspective. And there's so much more safety involved there. But that's an opportunity for the future. But when you look at the transition, that's just a fallacy. We're going to still be producing fossil fuels long into the future. And yes, we'll continue to get cleaner with them. And yes, we're going to continue to be more efficient with them. But all of that creates technology opportunities for us to invest in to help make that happen. Whether you talk about carbon capture, whether you talk about storage, whether you talk about battery, you talk about all these other things. But until those things really take over a significant portion of the energy production, you're going to still need fossil fuels. And if you're not drilling enough, if you're not finding enough, if you're not manufacturing enough, refining enough, if you're not delivering enough, you're just not going to have enough. And when that happens, prices are going to go up. And so 70 to 90 bucks a barrel has happened with no real issue in the world. It's just a supply demand problem. And 100 million barrels a day is going to grow from 100 million barrels a day to probably 102 to 104. And it does not take a large mismatch to create a dramatic dislocation in price. So we have assets that we're able to buy today that literally have a 15% current yield on traditional fossil fuels. You're able to find technology companies that are changing the way those fossil fuels are being processed. And then we are looking at other opportunities in the evolution to be able to invest in as well. But the low-hanging fruit right now is there was a great chart I saw the other day. Crude oil prices going like this, drilling activity going like that. Well, something's got to give. Either you're going to drill a lot more or prices are going to go a lot higher. Every politician wants to ignore that. Everybody who wants us to get away from fossil fuels tomorrow wants to ignore that. It's just obvious math. And we will get a transition over time or an evolution over time. But that's the key word. Over time. Until then, we're going to make money on all of the above.
But then that's going to drive inflation too, with energy prices going up.
Well, I mean, everybody talks about it and nobody wants to admit it, especially politicians. The number one driver effectively as a tax on the consumer is energy, whether it be charging their car or filling their car up with gasoline. It is, if you see $3 turn into $5, it affects their behavior. It's just going to suck money from other things they would spend it on, whether it be refrigerators, automobiles, restaurants, hotels, etc. And it doesn't happen immediately, but it becomes a compounding effect when you add it to higher interest rates, high credit card rates, less fiscal giveaways, and also the pressure that they're feeling from now, for many, student loans again, and just the general likelihood that we're going to see unemployment begin to creep up. It starts to really have a ripple effect.
Yeah. Well, Christopher, if you'll humor me, I have one more question for you. And it's about GP stakes, which I know is an area that you've been pioneering. And I find it fascinating, this notion that it's better to be a GP than an LP. Can you explain that for the folks and the work that you all do in that space? Because it sounds like that's another area in this kind of stagflationary environment too. Like you don't have that correlation, if you will.
This is the way I explain it. And forgive the Houston and the Texas analogy, but it's an easy one to give. Imagine that you're a boot maker and that you have a client who says, okay, I'm going to pay you $1 million a year to make boots for me. And you say, hey, great, that's a great contract. I'll be happy to do that. But oh, by the way, you say to that customer, it doesn't matter if I deliver them on time, in the right color or in the right size, you still have to pay me the $1 million. And you as the customer usually would go, But that's exactly what happens in the world of private asset management. They normally, again, using average, just traditional numbers here, the 2 and 20 that most people are familiar with. If somebody is paying a manager 2%, they're locked in for usually 5 to 10 years that they're going to pay 2% a year on their commitment to that fund for that 5 to 10 year period of time. Even if they never invest the money, if they invested poorly, if they lose money, it doesn't matter. They're still paying 2% for 5 to 10 years. That's a really good business. But imagine if you're a bootmaker and I say to you, as your customer, I'll tell you what, if you actually give them to me on time, in the right color, and in the right size, I'm going to pay you an extra $1 million. Now you think I'm the best customer ever. Well, that's exactly what happens in private asset management because people get the 20. So imagine if you raise $1 billion fund, you're going to get 20 million a year for at least 5 years, usually almost 10 years. That's real money, and you get to make that no matter what happens, which makes budgeting pretty easy, so you're highly profitable. But then you are a good manager, and you turn that $1 billion into $2 billion. You get to keep 20% of that billion. That's $200 million. Now you're talking about real money. So you're not going to stop there. You're going to do it again. And you're going to raise a $3 billion fund, and then a $5 billion fund, and then a $10 billion fund. Now you're talking about the reason why there's more people from this industry and this sector on the Forbes 500 than any other. It's a great business model, but they make more by being aligned and incentivized to do well for the institutional investors that invest with them. As owners of those firms, we love being the GP, and we don't mind being an LP at times, but it is better to be a GP where you get the benefit of the upside, but you also have the protection on the downside from those contractually obligated management fees, which give you so much predictability of cash flow and downside protection.
Yeah, it's fascinating. And I think you're the first person who I've ever heard this from, or at least brought it up. And it's better to be a GP.
It's a big industry, and it's very much something that's only been available to select few institutions. And obviously, it's something that we believe has enormous value for lots and lots of investors. And of course, we have been very involved in it and have some great partners there for the last almost decade now.
Yeah. Well, Christopher Zook, founder and CIO of CAZ Investments, I've enjoyed having you on. I always enjoy having you on the show, and you are welcome back anytime. I really appreciate you being so generous with your time and your ideas and your knowledge. Thank you again, Christopher.
Thank you. And I'm glad to be here. I look forward to talking to you soon.
Amazing.